Hello and welcome guys, and welcome to this session of SPM. And yes guys, now we move on to a theoretical chapter of our syllabus. And yes, BVM, there is not much importance or much emphasis to be given on theory portion, because in BVM there's hardly any theory which comes in the examination. Maybe in terms of MCQs, and guys, nowadays even MCQs are coming based on practical concepts and practical questions. So yes, I can easily say that you just have to brush up the theory portions of BVM in a very quick manner. You need not spend a lot of time in preparing the theory for BVM. Just read it twice or thrice and that's more than enough, and do not lay a lot of emphasis on it, because BVM portion will primarily come from practical aspect. But guys, SPM, there is an equal weightage which is given to the theory as well. So there are two chapters, chapter number 1, 2, 3 and 4. First and second chapter pertains to theory, and third and fourth chapter pertains to practical. So yes, first two chapters are holding about 20 marks in the examination. So guys, 16 to 20 marks is definitely coming from first and second chapter. So you have to do these two chapters very carefully from a theory standpoint. Guys, even from chapter number 4, which is risk management, theory aspect is asked in the examination quite frequently. So yes, you have to prepare chapter number 4 also from a theory standpoint. Today we are going to start chapter number 1 of your SPM syllabus. Chapter number 1 is Conceptual Framework of Performance Management. So guys, SPM, Strategic Performance Management, is entirely focused towards the results, is entirely focused towards the performance. Performance of management is not only dependent on the workers, on the employees, but also on several other aspects, including the management itself, the kind of decisions which management take. Those are also an important and integral part of the entire performance management concept. And performance management is the key, is the focus of the top level management. Guys, the top level management are not bothered about how you achieved a thing. They are more bothered about what is the achievement that you've made. So performance is one thing which is the key area which everyone looks out for. So let's start the chapter, Conceptual Framework of Performance Management. So first of all, let us see, what do you mean by performance management? Performance management is a continuous process. So guys, the first important word which I want you to highlight is that it is a continuous process. So guys, this is the prime difference between performance management and audit. Audit will happen once a year. At the end of the year, when auditors will come, audit will happen at that point in time. But guys, performance management is a continuous process, which means that it will go on and on for the entire year, and the companies, the managers, the top-notch people, the CFO, the CEO will review the performance of the company on each single day, and they would track the performance of the company for every month, every week or every fortnight. So it's a continuous process. It will not stop, or it will not happen at the end of the year. When everything is getting closed, our financials are getting closed, then we are monitoring our performance. Our performance is monitored actually on a monthly basis. Most of the companies monitor performance on a monthly basis, or yes, if they deep dive into months, they also track performance on a weekly basis or a fortnightly basis. So performance management, first of all, is a continuous process of identifying, measuring and developing the performance. So the threefold steps are that we have to identify, we have to measure and we have to develop the performance. First of all, we have to identify what is the performance expectations from our employees, from our departments, from our sales team, etc. So we need to identify the performance management measurement standards. Then we have to measure the performance of each one of them. Have they been able to meet the expectations of the management and meet the expectations of whatever was being planned for them? So second aspect is measuring, and third aspect is developing. So guys, if there is a delta between what was expected out of them and what have they actually performed, then that delta is to be curbed, is to be fulfilled by certain measures which are to be taken by the management. So we need to develop management, develop performance also, and of course the next target which we'll give to our players, to our employees, will definitely be higher than the previous targets, because growth and developing that growth is essential for every business. If you do not develop growth, you will stagnate, just like water. If water doesn't flow, it stagnates. Similarly, if management the employees, the organization, if it doesn't grow, it will stagnate. In organizations, by linking each individual's performance and objectives to the organization's overall mission and goals. So guys, a very simple technique of achieving organizational goal is that you need to link the emoluments of the employees, the incentives of the employees with the organizational goals, and then just see how the employees will work, how efficiently will they work. So naturally guys, employees have their own ambitions, employees have their own goals, their own mission which they want to achieve in life. They also want comfort in their personal life. So it's just that if you tell the employees that okay, you fulfill organizational goals and the organization will fulfill your goals, if there is a synchronization of individuals' goals and the organization's goals, you've played the trick. Things are done very easily if this synchronization is there between the employee's performance and the performance of the organization. So we need to link each individual's performance and objectives to the organizational goals and missions. Two important elements of performance management are that it is a continuous process. Guys, it is a never-ending process. It is not a year-end or a one-time process. It's an ongoing process. And second is that it's linked to missions and goals. The managers should ensure that individual goals of the employees with the goals of the organization. So these two things are in absolute synchronization. If these two things are in absolute synchronization, then you can expect that the organization will fulfill the desired targets. Then differentiate between performance management and performance appraisal. Guys, now this is a very crucial point where we need to understand, as managers we need to understand what is the difference between performance management and performance appraisal. So guys, I'll give you two scenarios. Scenario number one, a child is protected or is supervised by his parents. His parents would make sure that a child is given overall grooming, is given overall development opportunities, is given growth opportunities. And there are relatives means the extended family, who are also worried about child to an extent. But the relatives, the role that relatives play is that they would come at the year end and ask for marks. And they would give some random advices and suggestions to the students, to the children, that okay, you do this, you do this, you do this, then you will score good marks, and they go away. So the relatives come at the year end, just ask about your performance, what was your score in your class, etc., etc., give some advice to you and just go away. It's a one-way dialogue. But guys, parents ensure that each and every day the child is growing, each and every day the child is learning, the child is getting the necessary impetus which is required to learn, and each and every day is fruitful for the child. Parents don't wait for the year-end results. Of course, there is an excitement for the year-end results, but they don't wait for the year-end results to guide their children. They would enhance the capabilities of the children at each and every day. They would monitor the growth of the children, of their child, each and every day. That is the role of a parent. Similarly, guys, managers in the organization have a parental role rather than role of a relative. So management should not come at the year end and ask you, oh, what was your sales? Have you completed your sales target? Okay, how much leads have you been able to generate? Okay, you didn't generate this, that, and they would give just some suggestion and they would go away. That's not the way managers should perform. Guys, manager should behave like a parent. He should on each and every single day mentor the employee. He should guide the employee. He should act as a friend, philosopher, and guide to the employee. And he should ensure that the employees develop, the employees grow. So this is the difference between a parent and a relative. Same is the difference between performance management and performance appraisal. So guys, performance appraisal is a very narrow concept. Just like our relatives, just go over to your employees at the year end and just ask them, have you achieved your target? Oh, why didn't you achieve your target? What was the problems? Okay, you can do this the next time. That's it. That is performance appraisal. But performance management is, guys, to ensure a dialogue between the manager and the employee is there all through the year. It's not only the year end where dialogue should be there. Dialogue should be there on each and every day, each and every hour. Dialogue should be there. Fruitful dialogue. After every assignment, there should be some useful points which should be given to the employees, and employee should be able to build upon those points, and he should be able to grow himself as an individual, as a person, and as a professional. And there should be continuous performance management. It should not be a one-time approach. This is the big difference between performance management and performance appraisal. So guys, in good old days, performance appraisal was the thing which was prevalent, and managers used to come only once a year at the year end and ask about employees' well-being, ask about employees' performance, and give some suggestions. Probably go away, that's it. Fill up a form, which was a complex form, fill up a form and go away, that's it. This was performance appraisal, but it was prevalent in good old days. But guys, now this is no more a phenomena. Now the phenomena has moved from performance appraisal to performance management. Now the managers ensure that the employees are able to manage their goals well, and they are able to grow and develop as per the required standards. And managers ensure that while growing, while developing, the employees are given mentoring on a daily basis, on a weekly basis, or on a fortnightly basis. At least after each project which the employee handles, he should be able to get some feedback from the manager on his performance. This is the endeavor of performance management. So let's read. The performance management and performance appraisal are sometimes used synonymously, but they are different. Performance management is a comprehensive means it covers every aspect of your performance. Continuous and flexible approach to management of the organizations, teams, individuals, which involves maximum amount of dialogue between those concerned. So there's a dialogue, it's not a monologue. Performance appraisal is a more limited approach with which involves managers making top-down assessment. So guys, performance appraisal is a limited approach where top-down assessment happens. Only the manager speaks about employees' performance and rating the performance of their subordinate at annual performance appraisal meeting. That's it. The only objective of this particular performance appraisal is that you have to give a rating to your employees, and then your responsibility is off. So what is the major difference between performance appraisal and performance management? Performance appraisal is a top-down assessment. Performance management is a joint process through dialogue. It's not only that employee is listening. That's it. Employee is not just listening. He's given an opportunity to speak as well. Annual appraisal meeting happens for appraisals, but management happens on a continuous review, one or more formal reviews. Use of ratings. So guys, in performance appraisal, ratings are used extensively, but in performance management, ratings are less common, ratings are less relied upon, and the feedback is more relevant for the performance managers. Monolithic system, a flexible process. So performance appraisal is more like a orthodox, more like a traditional system in which the one person is speaking, another person is listening. But performance management is a more flexible approach, and there are no stringent formats which are to be filled in performance management. The manager of a particular team is free to grow and free to develop any technique which he wants to do for performance management. So guys, I've seen people in practical real life. I've seen my managers taking an individual to Starbucks or to cafe coffee day to discuss about his day-to-day performance. And the idea is to bring the employee out of that typical office environment, to ease off his mind, and so that he can easily speak out his mind. To give him more space, to give him more comfort, the managers would take the employees to say a dinner or a lunch or a breakfast session or a coffee session, and over there performance management happens. So performance management is a very flexible approach, but yes, quite a new approach. Earlier this performance management was not in vogue. So if you ask your old managers, managers who are there since say 40 years in profession, in corporate, guys, they are not aware about performance management. They are not aware about their managers taking them to cafe coffee day to have a performance discussion. They would say, oh, we don't know about it. But yes, today it is the need of the hour, because today's generation is not that generation who can really be improved by stick. Stick is a method which is an old method now. Now you need to actually be logical while dealing with today's generation. You have to give some solid logics to the today's generation. Only then will they be able to appreciate your point, and they will be able to work cohesively with you. Otherwise they would work disjointly with you. So performance management is a flexible process. So performance appraisal, the focus is on quantified objectives, So like sales target is the objective, or meeting some revenue targets, that is the objective. However, in performance management, focus is on values, behaviors as well as objectives. So objectives is of course there. Sales targets have to be met, that is for sure, but along with it, the focus is also on the behavior, on the values which are demonstrated by a particular employee. Often linked to pay. So performance appraisal is linked to pay, guys. As high your rating is, you will get a higher bonus, you will get a higher increment. So it depends on your pay. And performance management less likely to be directly linked to pay. In guys, performance management, it is very less likely that it is linked to pay. It is generally not linked to pay, because we do performance management on a regular basis. On a regular basis, we cannot give you bonuses, or on a day-to-day basis, we cannot give you bonuses. Bonus happens only once at the end of the year, and that process is to be followed, which is a typical rating process. But performance management, which happens over a period of time, guys, through that particular process, there is no connection with the pay. It is only focusing on the development and growth of the employee. Bureaucratic, complex paperwork. So guys, the performance appraisal is bureaucratic, as I've told you, old school, orthodox view, and not very relevant in today's dynamic and ever-changing environment, and today's fast-forward generation doesn't approve of performance appraisal techniques. Complex paperwork is there. I've told you a form is there, a very hefty form. It runs into 12 to 14 pages, where each and every attribute of the employee, how did he achieve those things, what was his performance, everything is to be written in great details. It's a very hectic and a time-taking process. Documentation kept to minimum. This is the best part of performance management, guys. Documentation is maximum 1 page. In performance management techniques, only 1 page is given to the manager, which he has to fill, and it's a very, very flexible technique and very, very easy to follow technique. Owned by HR department. So performance management appraisal is typically derived by HR department. HR department fixes dates, fixes how to conduct these appraisal meetings, fixes how to fill the appraisal form, etc., etc. So this particular process is owned by the HR department. However, performance management is owned by the line managers. So the entire autonomy is given to the managers. Managers decide whatever they want to do. Managers decide how to manage performance of their team, and not much of interference is there from an HR department. So guys, the practical part of it is that, if I would see today's practical world, today's environment, guys, a mix of these two things are being used by the companies. However, more weightage is given to performance management, less weightage is given to performance appraisal. Actually, the issue is, guys, we cannot completely weed away the performance appraisal bit. Why, sir? Why can't we? Because often the linkage to payment is of performance appraisal. At the end of the day, employees want their bonus. How will they get their bonus if there is no performance appraisal? So today in corporate world, there's a mix of performance appraisal and performance management. So managers are expected to manage their performance around the year, throughout the year, and the HR department helps the managers with that. But at the year end, an appraisal is necessary. Appraisal happens, and appraisal will decide the bonuses and other emoluments of the employees. So a healthy mix of both of them is seen in today's corporate world, but the slight tilt is towards the performance management bit. The more emphasis is lay on the performance management bit, because even HR knows that performance management will yield better results than performance appraisal. But yes, performance appraisal is also a necessity, so it has not been completely done away with. The performance management focuses mainly on achievement of results. So the basic thing about performance management is that it is achievement of result is of course the key, is the goal towards which everyone is running after today. And yes, performance management focuses and it ensures that the results are achieved by the organization or the management. Now, what is the performance management cycle? Guys, there's this cycle which is known as the performance management cycle, and performance management cycle means that we have to follow a particular pattern, we have to follow a particular trend, we have to follow step-by-step approach towards performance management. And what is that step-by-step approach towards performance management? It is, first of all, we have to plan, we have to set the goals, we have to ensure that whatever we as an organization wants to achieve, that is achieved by the year end. That is our ultimate goal. So the first and foremost is to plan, is to set a goal. Then we have to act. We have to devote ourselves to making some procedures, making some activities, making some actions that will help us in achieving those organizational goals and targets. So second thing is that we have to act. Third thing is we have to monitor our performance. Our performance is to be monitored. Our performance is to be seen, whether our performance is done or not, whether our performance is on the right track or not. So we have to monitor our performance on a continuous basis, on a regular basis. And last is we need to review. So finally at the year end, when the year ends or whenever your planning cycle ends, then you have to see whether your ultimate goals are achieved or not. And if they are not achieved, then what are the rectifying features that you need to install in your next year's plan, which can infuse efficiency in your working, that you have to see. So plan, act, monitor and review. These are the 4 steps in performance management cycle. Let's see what are these 4 steps. So components of performance management. Performance planning. First component is performance planning. First we need to plan the process of deciding the targets and the key performance areas for the years. Guys, we need to decide the target. What is the target and what are the key performance areas? In what areas are you performing your duties? Are you performing your things? So you need to decide the targets. What target should you achieve and what are the performance area which you should achieve. Second is performance planning is jointly done by employees and the employer. So performance planning is a joint process, and guys, a plan has to be made by the employer as well as employee, because unless and until employee gives his practical insights into the plan, unless and until employee tells his practical challenges which can be faced while achieving those plans, no plan can be practicable. Because sitting in an AC room, in boardroom, with board of directors, and just thinking about what is to be done and just writing it on a piece of paper is not sufficient. Guys, we need to achieve those targets also, and achievement will be done not by the board of directors but by the employees. So if employees are the epicenter of execution and action, then definitely planning should also contain useful inputs or essential inputs from the employees as well. So planning is actually not fruitful unless and until employees are involved in planning. So employees are an integral part of planning process. In the beginning of a performance session, every employee is given certain key performance indicators, key results areas which are to be adhered to by the employees. Then after the planning is done, it's complete, then employees are given their key responsibility areas, their key performance indicators, which at the year end will be evaluated, and those key performance indicators which are to be evaluated, those key performance indicators will be the barometer for the year end performance appraisal. Okay, sir. Next step is to performance appraisal and reviewing. Next is, guys, the appraisee fills self-appraisal form and also describes his or her achievement in quantifiable terms. After the self-appraisal, the appraiser or the reviewer offers the final rating for achievement of employees being appraised. So guys, the second step towards performance management is that after each assignment or after each month or after each quarter, as the case may be, the employee should fill up his own form, fill up a detailed description of whatever he has done in the past month or the past quarter, and he should tell about his achievements, about his shortcomings, about his weaknesses, about his losses, whatever he wants to write. He should just give a descriptive detail of whatever he has achieved or not been able to achieve during the particular appraisal period. Because on the basis of that particular document or on the basis of that particular format, the appraisee will be able to give his or her comments. So second is to self-appraise, which means to review yourself, to review the employee's own strengths and employee's own weaknesses. We fill a performance appraisal form. Then feedback on performance followed by personal counseling, performance facilities. Guys, this is an important step. Whatever the employee has been able to achieve or whatever he is not been able to achieve, guys, all those things are to be explained, are to be taken into cognizance by the managers, and all those things are the basis of the platform of deciding whether employee was successful or not during the current year. So this step entails you give feedback to the employee, and you should tell the employees what are his weaknesses. Of course, strengths are to be told first so that employees' morale is boosted, and then his weaknesses are to be highlighted, and feedback is to be given, and then personal counseling session are to be given on how to overcome those weaknesses, because just telling weaknesses is not sufficient. If you are a true mentor, if you are a true manager, then guys, you have to instruct your employees on how to improve the weaknesses as well. So for that improvement, personal counseling is required, and performance facilitation. This is a stage in which employee acquires feedback from the appraiser about areas of improvement, and also information on whether employee is contributing to the expected level of performance or not. So whether the employee is contributing to the best of his abilities and to the best of the requirements of the job. Both things are important. So feedback is important, and performance appraisal techniques, how to improve the performance, that is also important, which is definitely to be given by the performance manager. Then rewarding good performance, guys, unless and until you have a reward for every good performance, the employee will not be motivated. Guys, at the end of the day, we all are human beings, and one peculiar thing about human beings is that they are motivated by the outcome, the results, the benefits which they will get from this particular outcome or the result. Guys, even if you are doing CMA, then you are not just doing CMA to acquire knowledge or just to be knowledgeable. Your purpose is to get a good job, get a respectable corporate life, and to get a salary, and to lead a easy life, to lead a carefree life, to lead a efficient life. So your objective is also very clear, that after doing CMA, you want to join a job, and for joining a job, you need to clear CMA. You need to have a degree, professional degree with you, and if you get that degree, then your motivation is that you will get a good job, you will get a good package. So everyone is driven by reward. Similarly, employees are also driven by a reward. During this stage, an employee is publicly recognized for good performance and is rewarded. This stage may have direct influence on self-esteem and motivation. Our employees should be motivated. Our employees should always be self-motivated towards achieving of task. And this rewards, any kind of rewards or reward schemes would play a very, very important role in the morale and motivation of our employees. Next, performance improvement plans. Guys, these are very important. This is a very important step that, okay, my employee has been able to achieve last year's performance. Very good. He was given a target of 10 lakh rupees. He did 11 lakh rupees of sale. Very good. He's been able to perform well. But next what? Would he attain that level of sales next year also 11 lakh? And next year also 11 lakhs, and next year also 11 lakhs, or would he escalate to a different level in each of the years? Ideally, everyone should escalate. So if in year 1 that person has been involved in marketing, next year he should be involved in production, so that his overall development happens, his personality increases, and his capabilities are increased. That is also an important part of development. So performance improvement plans are important elements to improve performance of any individual. In this stage, fresh set of goals are established for an employee, and as far as my experience goes, it is not only fresh set of goals but also higher level of goals. Higher level of goals are established for an employee, and guys, higher not only in monetary sense. I mean, last year your sales was 11 lakh, we want you to do 15 lakh this year. Not only in monetary sense, but also in terms of taking more responsibility. So if last year, the employee was handling a team of say 4 staff, this year he would be expected to handle a team of say 7 staff. So higher level of responsibility is expected from each one of us, from each of the employees. So the goals are being escalated, the goals are to be increased by each going year. For the next appraisal cycle, a new deadline is provided for accomplishing those objectives. The employee is clearly communicated about these areas in which the employee is expected to improve, and a stipulated deadline is also assigned within which the employee must show this improvement. So these are the development techniques, the growth techniques which are given to the employees, and the opportunities which are given to the employees, because stagnancy will result into obsolescence. We don't want our employees to be obsolete. We want our employees to be dynamic. We want our employees to be very efficient in their entire work. Next, potential appraisal. Potential appraisal forms a basis for both lateral and vertical movement of the employees. Potential appraisal provides crucial input for succession planning and job rotation. So guys, a potential appraisal means that whenever an employee is looking forward for a promotion or a job salary hike or a job shift from one profile to another profile. So guys, in this scenario, we have to not only see the past performance of the employee, but we also have to see his potential. So suppose that I have an employee who is a marketing manager, he is very good in marketing, I want to shift him to production. Can I just shift him to production seeing his marketing performance? Answer is no. I have to see certain characteristics in him. I have to see certain potential in him that yes, he'll be able to work well in production department as well. And only after I see those hints, those elements in him, only then will I qualify him for the next level. The next level is production department. So potential appraisal is very important. So what this employee is capable of doing. Potential means whatever you are capable of doing. We want our employees to achieve their full potential. So whatever they are capable of doing, we need to appraise our employees on the basis of their capability also. So potential appraisal means that we need our employees to be qualified, to be potential, to exploit their potential, and we want their hidden talents to be unleashed and nurtured. This is the objective of potential appraisal. Potential appraisal. It will give opportunities of job rotation to the employees. So potential appraisal is definitely one of the important steps of appraisal process. If we want our employees to grow, if we want our employees to develop. So potential appraisal is an important element. Then what are the tools of measuring performance? What are the two ingredients of performance, guys? They are productivity and efficiency. So there are two things: productivity, how productive are you, how much quantity of output are you generating, and efficient means are you using the resources efficiently, are you using the resources cautiously, are you wasting the resources. So efficiency means how much resources are being utilized for giving a stipulated performance, and productivity means what is the quantum of performance which you are giving. So performance of an employee, a business unit, or an organization as a whole may be measured by using two tools, productivity and efficiency. Productivity examines the output produced in a given production. So whatever is the output produced is the productivity. Put simply, productivity is the quantity of work produced by a team. So what is the quantum of work which your team has produced? That is known as productivity. Business or individual, hence the productivity focuses on quantity. So quantity is the focus of productivity, but efficiency on the other hand refers to resources used to produce that work. In other words, efficiency may be defined as the highest productivity level from each input level is recognized as efficient situation. So guys, every input is to be used cautiously, is to be used in the most appropriate manner, and if it is done, if it is used in the most appropriate manner, then I will say that yes, my operations are efficient. Hence efficiency occurs if a firm obtains maximum output from given set of inputs. Hence the efficiency focus on quality. So you have to use minimum resources to produce maximum output. That is the measure of efficiency. Producing maximum output without caring about input is the measure of productivity. This is the difference between efficiency and productivity. So producing 100 quantity of finished goods an hour may look good on productivity fund, but it's not very efficient if half of them are rejected because you don't meet quality standards. The goal is to maximize both productivity and efficiency, or to produce the maximum possible highest quality output using fewest resources. So that is the difference. Okay, now what are the types of efficiencies, guys? Efficiency is also of various types. Efficiency consists of two main components, technical efficiency and allocative efficiency. So there are two efficiencies which are popular. First is the technical efficiency, second is the allocative efficiency. Let's read. Technical efficiency occurs if a firm obtains maximum output from a given set of inputs. So inputs are being introduced, and if you are getting maximum output from it, that is known as technical efficiency, which is generally known by us. Allocative efficiency occurs when a firm chooses optimal combination of inputs given the level of prices and production technology to produce output at least cost. So guys, suppose we have two inputs which can be used absolutely equally in producing a particular output, and two inputs are substitute for each other. Two inputs are substitute for each other, and those two inputs are equally good in every situation, then naturally a businessman will look for an input which is cheaper than the other inputs. So naturally in this case I will use the input which is the cheaper one. The cheaper input will be used more. But in a situation where input is to be mixed in an appropriate combination, so for example, guys, gold is too soft a metal, so it has to be mixed with impurities. Impurities means some other metal like maybe copper or any other metal to make it strong. To gain that strength, we need to have an appropriate mix of gold and other metal. Then now what this mix should be? You've heard 21 karat jewelry, 20 karat jewelry, 18 karat jewelry. So what should this appropriate mix be? Determining this appropriate mix of inputs is known as allocative efficiency. I need to allocate weight to my inputs. Undoubtedly, input has to be used in best possible extent, but to combine two sets of input and to give them best possible proportion, to give them best possible ratio, which is cost effective as well as it gives me the best output also, that is known as allocative efficiency. So this is the difference between technical efficiency and allocative efficiency. So financial performance analysis. Financial performance analysis is the process of identifying the financial strengths and weaknesses of the firm. So what are the financial strengths and financial weaknesses of a firm? Short-term and long-term growth prospects. So what are your growth prospects? That are also a part of your financial performance analysis. Financial analysis involves use of financial statements. Foremost things that we would pick up as a financial analyst will be financial statements of any organization for over a period of time, say 5 years. That is our basis for financial analysis. The term financial statement generally refers to three basic statements: balance sheet, income statement and cash flow statement. Guys, these are the three statements which are required to be made for every company, which is mandatory by the Companies Act. Balance sheet shows the financial position, assets and liabilities position of the firm at a given point of time. Balance sheet is a summary of a firm's financial position on a given date that shows total assets is equal to total liabilities plus owner's equity. Then there is an income statement. Income statement, referred to in India as profit and loss statement, reflects the performance of the firm over a period of time. Income statement is a summary of firm's revenues and expenses over a specified period, ending with net income or loss for that particular period. So whatever has been the income, whatever has been the expense of a particular organization at a particular given point in time over a period of say 1 year or so, that is known as income statement. Then what is cash flow statement? Cash flow statement depicts the cash accruals of period under consideration. It can be prepared either by direct method of receipts and payments or by indirect method of adjusting increase or decrease in liability and non-cash assets to profit or loss. So cash flow statement means what is the description of cash which has been earned by you or cash which has been expelled by you. Now guys, a very objective way of looking at it is that if you trust profits which are non-cash profits, I mean which has the cash element as well as the non-cash element, the normal net profit which we earn, any business earns, that normal the profit which earns, guys, that profit contains two elements: cash elements and non-cash elements. And mind you, these non-cash elements are nothing but accountants' assumptions and presumptions. They are influenced by accounting policies. They are influenced by accounting standards. They are influenced by estimates, the provisions, the actuarial valuations which the accountants are doing. So non-cash profits are highly influenced by accountants' policies or accountants' principles and measures. So guys, this non-cash profit is not a very reliable source of information on profits of a particular company. And if you really want to analyze a particular company's profit, then guys also focus on the cash profits, because cash profits are the profits which are actually flowing into the organization and it is filling pocket of the organization. The non-cash profits may be flowing in due to the estimates of the accountants. They are highly impacted by the accounting policies. They are highly impacted by the accounting standards, and we don't know what kind of accounting policies are adopted by the company. If you are, if you deep dive into the financial statements, only then will you be able to understand the accounting policies or accounting rules and regulations of an organization. But otherwise, if you are a layman and you are not much into financial statement analysis, then guys, you will not be able to understand the policies and accounting concepts which are influencing the non-cash profits. And therefore, these cash flow statements play a very important role to showcase the actual position to the outside world, to the investors at large, to the creditors, to the debtors. So cash flow statement is a very, very important statement, and I suggest that all of you must see cash flows of a particular company if you want to invest in that particular company. Financial analysis is the process of evaluating the relationship component parts of financial statements to obtain a better understanding of firm's position and performance. So, financial analysis evaluates the relationships between various parts of financial statements, and they tell you what is the position, financial position of an organization, or what is the financial performance of an organization. What are the benefits of financial performance analysis? Interest of various related groups is affected by financial performance of a firm. Therefore, these groups analyze the financial performance of a firm. Trade creditors. Trade creditors want to ensure the liquidity of a particular firm. So, the trade creditors would analyze the financial statements from the perspective of liquidity, short-term liquidity and long-term liquidity. For bondholders, again, it is a long-term liquidity. Again, it is cash flow ability of the firm, appraisals of firms, capital structure, the major sources and uses of funds, profitability over time, and projection of future profitability. Because guys, the only worry which bondholders has is that their money should be safe in hands of the company. The money should not be lost in the risky propositions. So that is the main aim of the bondholders. Investors, what do investors seek? They seek present and expected future earnings. So what are the earnings of an organization? Investor is looking for earning more and more with lesser and lesser investment. As well as stability of these earnings, appraisal firms, profitability and financial condition. What is management seeking to achieve from the financial statements? Interested in internal control, better financial condition, better performance. Appraisal of firms' financial condition. Evaluation of opportunities in relation to the current position. Return on investment provided by various assets. So what is the return on investment which is provided by various assets? All these things are forming an integral part of what management seeks from performance financial analysis. Areas of financial performance analysis. Now, what are the different segments of financial statements which we analyze, guys? Different things showcases different stuff. So, for example, debt equity ratio. It showcases long-term liquidity position of a particular company and how risky is the company. That is the demonstration which debt equity ratio shows us. Now, what is current ratio? Current ratio, guys, it demonstrates the short-term liquidity position, the short-term viability position of a particular organization. So, this is how different ratios or different analysis which are deriving from the financial statements only, they showcase different things to us. Let's see what are the things which are showcased by each of these financial analysis positions. Working capital analysis, financial structure analysis. Working capital is current assets, current liabilities. Financial structure is debt and equity. Activity analysis, activity means what are the turnover ratios, how much activity has happened. So stock turnover ratio or sales turnover ratio, inventory turnover ratio. Guys, these are the ratios which are denoting the activity analysis. What is the level of activity which an organization is doing? Then profitability analysis. Yes, this analysis gives us the details of net profit, gross profit, etc. Whatever profits are being earned and what are their ratios to sales, what are their ratios to investments, return on capital, etc. These are the profitability analysis. Then techniques of and tools of performance analysis. Guys, the first technique of performance analysis of any company, the first basic stuff which you can do to analyze financial statements of a company is to compute the ratios, various ratios which have been taught to us since our 11th standard, current ratio, debt to equity ratio, working capital ratio. Guys, all these ratios are pivotal in forming the analytical part of a particular organization. So, ratio analysis. Ratio expresses numerical relationship between two or more things. This relationship can be expressed as a percentage of 25% of revenue, fraction 1/4 of revenue, or proportion of numbers. Ratio analysis plays an important role in determining the financial strengths and weaknesses of a company relative to that of other company in the same industry. So if you want to compare two companies which are there in the same industry, we use ratio analysis. The analysis also reveals whether the company's financial position has been improving or has it been deteriorating over a period of time. So if we see ratios of say past 5 years, then guys we would have some useful insights into whether the performance of the company is increasing by the day or is it deteriorating by the day. Ratios can be classified into 4 broad groups on the basis of items used: liquidity ratio, capital structure ratio, profitability ratio, and activity ratio. So guys, all these ratios which have already been studied by us in our 11th and 12th is now very, very important, because sometimes a question of say 4 marks, very basic, there is nothing very hanky panky, nothing very complex will come from these ratio. A very basic question of computing the ratio, and more importantly analysis of that ratio. How do you analyze the results which you get from a particular ratio? This kind of a question can be asked by the examiner in the exam, and you just need to remember the basic formulas of these ratio and what are the ideal ratios. So guys, let me tell you, ideal ratios are generally, on a practical level I'm telling you, that they are generally varying from industry to industry. So yes, you might have studied that debt equity ratio, an ideal situation should be 2:1. But guys, in industry which are highly risky industries, their debt equity ratio of 2:1 is too high. So ideal ratio can be 1:1 or can be even lower than 1. So it depends on which industry are you working, and as per the industry ideal ratio changes. But there are certain set standards of these ideal ratios which can be used as benchmark for every industry. So you can use this benchmark for every industry and you can solve your exam questions easily from these particular benchmarks. But don't think that at practical level you will say that, oh, every industry should have a debt equity ratio of so and so, and this is the ideal debt equity ratio. There is nothing called an ideal debt equity ratio which is prevalent for all the industries which are prevalent. Okay, sir. So first of all, liquidity ratio. Liquidity means what is your ability to pay your short-term obligations. That is known as liquidity ratio. Short-term or long-term, that is known as liquidity ratio. And guys, this ratio is denoted in 2 parts. One is the long-term liquidity ratio. Second is the short-term liquidity ratio. So net working capital, current assets minus current liabilities. It measures the liquidity of a firm. Current ratio, current assets divided by current liabilities. It measures the short-term liquidity of the firm. Please underline the word short-term equity. A firm with a higher ratio has better liquidity. A ratio of 2:1 is considered as safe. Asset test or quick ratio. Quick ratio means I will not consider all the current assets. I will only consider those current assets which will be quickly transformed into money. They are very quickly transformed into money. For example, short-term marketable securities. Those are quickly transferred into money. Mutual funds, quickly transferred into money. So in quick ratio, I will only take those components which are quickly transformable into cash. Then turnover ratios, guys, these are activity ratio. What is your turnover? So for example, if you have say inventory worth rupees 2 lakhs and your sales is 20 lakhs, then your turnover ratio is 10. After maintaining 2 lakh rupees of inventory, you are earning a sales of 20 lakhs. Ratio is 10. So guys, keeping inventory also entails cost. So I want to reduce inventory and increase my sales. That is why this ratio is prevalent. Then another ratio, fixed assets turnover ratio. How much fixed assets have you employed in the business and how much sales are you deriving from them? So suppose your competitor is employing 10 lakh of fixed assets and it is deriving 1 crore of sales from that particular investment. And guys, you as an company, you are investing 50 lakhs and deriving the same turnover. So now this is a starking difference. Why should you invest so much more in a business that is reaping you same turnover? That is a matter of concern. So the turnover ratios tell us what is the level of activity in our business and how fast do we need to increase the level of activity in our business. Turnover can be inventory turnover ratio, debtor turnover ratio, creditor turnover ratio. Inventory turnover ratio means how fast inventory is sold. A firm with a higher ratio is better liquid. The ratio measures how fast the debts are collected. So if you keep your debts for a longer period of time, then it's a problem for the company. High ratio indicates shorter time lag between credit sales and cash collections. Creditors turnover ratio. High ratio shows that accounts are to be settled rapidly. So how fast are you settling your creditors? How fast are you repaying your creditors? That is the creditors turnover ratio. Capital structure ratio, debt to equity ratio, and debt to total capital employed ratio. Guys, debt should be involved in your capital structure because it gives you a financial leverage benefits. Unless and until you get financial leverage benefits, your working will not be efficient, your working will not be fruitful. So definitely your debt should be an essential element of your capital structure, but it shouldn't be too much also, because it will increase risk. It shouldn't be too much, it should be rampant. It should be in a limited capacity. Sir, how would you know what is the adequate debt equity size? Guys, you can see your competitors, you can see your industry in which you are working, what are their debt equity ratios. You can see that and you can experiment with your company. So try and increase debt equity ratio above the ratio which is generally expected in the market, and see the impact on the share prices of this particular increase. You will yourself see what is the impact of increasing debt equity ratio. So the ratio indicates relative proportion of debt and equity in financing, and it indicates proportion of permanent capital of the firm consisting of long-term debt. So 1:2 is considered as safe. It measures share of total asset financed by outside funds, low ratio desirable for creditors, etc., etc. Then coverage ratio. Guys, we had studied a particular concept of coverage ratio where I had made two umbrellas for you. So umbrella represents the coverage which is there. Obviously a larger umbrella will give you better security. A lower umbrella will give you lesser security. So coverage ratio should be as large as possible. So to cover the interest of an organization, to cover the interest cost, we need good profits. We need huge amount of profits. So in my coverage ratio, I need to have good profits to cover my interest. So a company which has 2 times the profits as compared to interest will be less riskier than a company who has 1.5 times of profits to cover the interest. So this way we compute the coverage ratios. Interest coverage ratio, earning before interest and tax divided by interest. A ratio used to determine how easily a company can pay on outstanding debts. The ratio for more than 1.5 is satisfactory. Then dividend coverage ratio. So guys, how much a preference dividend can this company is this company paying, and what is the ratio between the earnings which are left for the equity and preference dividend, and out of which how much is being paid to the preference dividend. This is the preference dividend coverage ratio. It measures the ability of firm to pay dividend on preference shares. A higher ratio is better for creditors. Then total coverage ratio, which means both preference and interest. If I want to see what is their coverage, both of them, then I use the ratio of total coverage ratio. It shows overall ability of the firm to fulfill the liabilities. A higher ratio indicates better ability. Then guys, profit margin ratios, and these are quite familiar to you. Profit margins, net profit, gross profit, these profit margins yield the level of margins and profits which we have. Gross profit is gross profit divided by sales. Net profit is net profit divided by sales. It measures the profit in relation to sales. A firm should neither have a high ratio nor a low ratio. So the ratio should be adequate. It measures the net profit of a firm with respect to sales. So a net profit ratio is net profit divided by sales. A firm should neither have high ratio nor have a low ratio. So firm should not have a high ratio, should not have a low ratio. There should be an adequate net profit ratio. Expense ratios. Guys, now we also need to consider our expense with respect to our sales. Expenses can be cost of goods sold respect to sales, specific expense with respect to sales, and other expense with respect to sales. Idea behind these ratios is that, guys, we need to control our expenses. And if we need to monitor and control our expenses, then we should be wary about the existing level of expenses which are being incurred by us as compared to what industry is expending. So if industry is expending, say, 5% of their total sales on marketing, why are you spending 10%? Are you yielding any specific returns because of spending more on marketing? And another example can be administrative overheads. Why are your administrative overheads more than what is generally acceptable or what is generally prevalent in market? Why? There's no need. So these expense ratios cover the ratios of expenses with respect to sales, and operating ratio shows operational efficiency of the business. Lower operating ratio shows higher operating profit and vice versa. It measures cost of goods sold per sale. It measures the specific expenses per sale. Then guys, return ratios. Return ratios, what is the return that you are gaining from your investment? What is the return that you are gaining on your capital employed? What is the return that you are gaining on your shareholders' equity? So there are various forms of returns. Returns can be on equity shareholders, return can be from debt holders, return can be from overall both of them. So return on net assets, net profit after tax divided by total sales. It measures profitability of total funds per investment of a firm. Return on capital employed is net profit divided by total capital employed. It measures profitability of the firm with respect to total capital employed. The higher the ratio, more efficient use of capital employed. Return on total shareholders funds, net profit after tax divided by total shareholders equity. It reveals how profitably the owner's fund has been utilized by the firm. So how much of the equity is being utilized on for generating profits of the firm. Return on ordinary shareholder equity, net profit after tax and preference dividend divided by ordinary shareholders equity. It determines whether the firm has earned satisfactory return for its equity holders or not. Then guys, the next set of ratios are the shareholders ratio, which are particularly relevant for the shareholders. And shareholders, while making a decision with respect to investment or while making a decision with respect to withdrawing of investment, in both the situations, shareholders have a look at these ratios. First is the earnings per share. We popularly known as, we call it as EPS. It measures the profit available to equity shareholder on a per share basis. EPS on a per share basis. Then dividend per share, net profit after interest and preference dividend paid to ordinary shareholders divided by number of ordinary shares outstanding. So what is the dividend which has been paid to each of the shareholder, that is known as DPS. Then dividend payout ratio. So as guys, DPS is the net distributed profit belonging to the shareholders divided by number of ordinary shares. Dividend payout ratio is how much of the entire earning are you paying out as dividends. That is the dividend payout ratio. Shows how percentage share of net profit after tax and preference dividend is paid to equity shareholders. A high DP ratio is preferred from an investor's point of view. So a high DP ratio is a better from an investor's point of view. Earnings per yield. So what is the earnings that is being recognized or earned by you per your share? For every share, how much earnings are you gaining? So earning per share divided by market value per share is the earnings yield. It shows percentage of each rupee invested in stock that was earned by the company. Dividend yield. Now what is the dividend per share that you are earning by investing the money in the market price of the share? So this is known as dividend yield. Dividend per share divided by market value per share shows company pays out in dividend each year relative to its share price. Price earning ratio is a very common but a very useful ratio which tells us what is the price at which the shares are trading and what is the earnings which one share is giving to me. Market price per share divided by earnings per share. It reflects the price currently paid by the market for each rupee of EPS. Higher the ratio, better it is for the owners. Earning power, net profit after tax divided by total assets. So guys, what is the earning power of a particular organization? That is denoted by the net profit which is being earned divided by total assets. It measures the overall profitability and operational efficiency of a firm. So what is the overall profitability and efficiency of a firm? This is known as earning power. What are activity ratios? And we have already discussed a few of them. Inventory turnover ratio, raw material turnover ratio, work in progress turnover ratio, and debtors turnover ratio. So guys, we need to check out our inventory balances, our raw material balances, our work in progress balances, our debtor balances as compared to the sales. Because if our inventories are huge and the sales are not as expected, then we are at a loss. Because inventory involves carrying cost. We cannot afford to pay carrying cost unless and until the inventory is giving me adequate sales. We cannot afford to incur the carrying cost.